Okay, good morning, good people. Good morning. Good morning, good morning. If you can hear me, good morning, ladies and gentlemen. If you can hear me, good morning. Are you getting me the sound? Is it clear? The video, are you seeing me, good people? Okay, if you can hear me, as we said yesterday, today we are going to discuss share-based, and if possible, we also discuss income taxes. Share-based payment, share-based payment. That is IFRS 2, IFRS 2, IFRS number 2, share-based payment. Now, when we talk of share-based payment, is a transaction in which an entity or a company acquires goods or services, and in return, it compensates the supplier or the employees by issue of ordinary shares, by issue of its equity instrument. You acquire goods or you receive services, but in return, you compensate by issue of equity instruments, That is share-based payment. Now, IFRS 2 sets out the required treatment of this transaction in situations whereby these transactions need to be accounted. Therefore, IFRS 2 specifically will show us how should we account for the purchase of goods and issue shares, or we receive services and we issue our equity instrument. Therefore, under this, remember, we have the supplier or employee. This supplier or employee, let's begin with supplier, is giving out goods, and now he needs to be compensated. Now you are being compensated by equity instrument of another entity. You are compensated by equity instrument, or employee is giving services, but now instead of cash, he is given equity instrument of an entity, equity instrument of an entity. Now, there are three types of share-based payment, good friends. There are three types of share-based payment. Number one is equity settled, share-based. Number two is cash settled, share-based payment, share-based transaction. Then number three is choice between equity and cash. Choice between equity and cash. Those are the three types of share-based payment. Now I say that under share-based transaction, you supply goods or the company acquires goods or services, but in return, it compensates by issue of equity instrument, including ordinary shares. Equity instrument, including ordinary shares. Now, I have said that we have three types of share-based payment transactions. Number one is equity settled. Now, when we talk of equity settled, now the company will receive goods or services, but in return, it will purely issue its equity instruments. You issue its equity instrument as consideration. But when we talk of cash settled, you issue shares, you receive goods from another party, but now in return, you compensate by way of cash. Remember, you pay cash, but this cash is based on the fair value of equity instruments. The cash you pay under cash settled is based on the fair value of the equity instrument. Then we have choice between equity and cash. Now the counterparty or the parties have the choice to either compensate by equity or by cash. Therefore, you have a choice either to receive your consideration as either cash or by equity instrument. That is the choice between equity and cash. It's a hybrid transaction where you can choose any of the above, any of the two. Then it is different. It is important, good friends, to differentiate between equity and equity settled and cash settled. Because now, how we account in certain ways, it will be different between equity and cash. Therefore, when we shall do them when we come there, how to differentiate equity and cash. Because now in the treatment, there will be a difference at some point. Now, good friends, before we go far, there are some key terms that we need to understand, key terms in share-based that we need to understand, key terms that we need to understand. Number one term that we need to understand is to vest. Now, to vest means to become entitlement. Remember, for this contract or this transaction to happen, an entity, because it's compensating the employees, it can have some conditions that you must meet before you qualify for this share-based transaction. Therefore, now, for you now to qualify, we say you have vested. For you to meet all the conditions and qualify to satisfy all these conditions, we say you have vested. You have vested. Vested, then you have qualified for the transaction. Then we have number two is the vesting conditions. Vesting conditions. Now, vesting conditions means these are the conditions that you must satisfy before you become entitlement to equity instrument of another entity. The conditions that you must satisfy before you become entitlement. And these vesting conditions can be in two ways, either service condition or performance condition. Service condition means you need to meet a certain service criteria. For example, certain years in the company. For example, we can tell the directors that you need to finish 5 years in our company for you now to qualify for this share-based payment. Therefore, that 5 years is the vesting period. But now to finish that five years is a condition that you must satisfy. Therefore, it is now a service vesting condition. Then performance condition means that we need now to get certain performance targets. For example, it can be profits. We say if we hit a profit of like 100 million during the year, then we shall do this to our employees. Therefore, that is also a performance condition. Those are two types of vesting condition. Number one is service condition, where you need to finish a certain period, a certain specified period. Then we have performance condition, where you need to meet a certain target. You meet a certain target, then you qualify to a share-based payment. Therefore, vesting condition is very important. We shall see when we come to computation the importance of this vesting condition. Then number three, we have something called fair value. Fair value. Fair value means the amount at which an asset can be exchanged or liability settled between knowledgeable willing parties at an arm's length transaction. The price, the amount at which an asset can be settled or an asset can be exchanged, and liability settled between knowledgeable willing parties at an arm's length transaction. Like, for example, you can meet me on the street, then you want to make a transaction with me. For example, you want to sell your mobile phone, then I'm also willing to buy it. Then we sit down and we agree that this is the price we are exchanging this asset. That becomes the fair value of that asset. There is no influence in the price that maybe you know me or I know you. Therefore, that is the fair value, the amount that an asset can be exchanged or liability settled between the knowledgeable willing parties at an arm's length transaction. When I say arm's length transaction, I mean at an independent transaction. The transaction is very independent from any influence. That is fair value. Then we have number 4, good friends, the grant debt. Grant debt. Grant debt means the debt when the counterparty enters into contract, into agreement. For example, today I meet you, then we agree on something that going forward we shall be doing this together. That is the grant debt. The debt when we enter into agreement, Then number 5, we have something called measurement debt. Measurement debt is the debt when the fair value of equity instruments is measured. When the fair value, for example, today we agree that our fair value shall be shillings 20 per option. Therefore, this is now the measurement debt of this fair value. Therefore, measurement debt is the debt when the fair value was measured. The fair value was measured. That is the measurement debt of the fair value. Therefore, when you are asked to define what is the measurement debt, according to IFRS 2, then it is the debt when the fair value was measured. The fair value was measured. Therefore, these are the terms that we are going to use mostly under IFRS 2 share-based payment. The terms that we are going to use under IFRS 2 share-based payment. We have first is to become entitlement to a share-based payment transaction. Then we have vesting condition, the condition that you need to satisfy before you become entitlement under share-based payment transactions. Therefore, let's move forward and now come to how we account for these types of share-based payment: equity settled and cash settled. Equity settled and cash settled. Equity settled and cash settled. Let's begin, good friends, with equity settled, accounting for equity settled. Accounting for equity settled transactions. Now remember, the IFRS 2, the essence of IFRS 2 under this is how to account for an expense or a liability under a share-based transaction. How to account for the liability or an expense. Remember, initially, before now IFRS 2, many companies were issuing shares as compensation, but now they were not accounting for that expense, that service. Remember, when you receive a service, it's an expense. Therefore, whenever you issue shares, it is paying for an expense. But now, because the companies were not incurring any cost, you are not incurring any cost, cash cost, that I'm paying something. Therefore, they were not accounting for these transactions as an expense. Therefore, the only thing that were recognized is the issue of shares, increase in shares. But now the expense were not recognized initially. But now IFRS 2 sets out the criteria on how we should recognize the expense and how we should recognize the liability. Now, under equity settled, if you are computing expense under equity settled or liability under equity settled, we only adopt the fair value and the grant debt. And as I said, the grant debt is the debt when we entered into agreement, when the counterparty entered into agreement. That is it is called the grant debt. Therefore, when we are computing the expense and the liability, we need now to account for the expense and the fair value is the fair value at grant date. Now, when we are accounting for this equity settled, remember we need to recognize the expense or liability, or to recognize the asset. If, for example, I'm receiving the asset for the shares, I need to recognize the asset. Therefore, I will recognize the asset or the expense when I receive the goods. For example, if it is goods, then I recognize the goods, that transaction. If I'm using this share-based transaction, remember on recognition, examiner can ask you under share-based payment, explain how the expense, asset or expense is recognized under share-based payment transaction. Therefore, under this, if it is goods or services, we recognize that liability or that asset. Remember, when we get goods like inventory, that is an asset. Therefore, we recognize the goods or the asset, that asset, when we receive it. When we receive that goods or that asset is when we can now recognize in the books. And now on the surface, we recognize the expense or the liability when the service is provided, when that service is provided. That is when now we recognize in the books. That is when we recognize in the books. Now, under this, remember on measurement of this share-based, measurement of equity settled, measurement. We can be asked the measurement of equity settled transaction. Now we have something called vesting. Vesting, as I said previously, vesting means becoming entitlement. Now the right to receive either equity instrument of another company or an entity. Vesting. Therefore, how do we measure transactions under equity instrument? Now we have something called vesting. If there is no vesting condition attached to this transaction, there is no vesting condition, then we recognize that transaction immediately. We receive it. For example, we receive goods or service, then we recognize the payment and everything at that point. But now, if there is any vesting condition, that is attached to this transaction, then we recognize over that period of the vesting period. If there is any vesting, yes, then it means that we need to recognize this over the period of the over this vesting period. That expense or liability, we recognize it. It's like we spread it over the vesting period. That is on measurement of this share-based transaction. Like we can look at an example. We can look at an example in November 2016. Let's look at an example of November 2016. November 2016, there is a question that we can try to look at how to measure this, how to recognize, and how to measure the expense or liability. And as I said, it is important, good friends, to differentiate between equity settled, and cash because of now the recognition, Because how do we recognize equity? When I'm paying an expense under equity settled, it means I will debit either asset or expense and credit equity instrument at that point, if it is equity settled. But if it is cash settled awards, then it means that I will debit my asset, then or expense, then I credit my liability. I credit liability if it is cash awards. I will debit asset or expense, Debiting has no problem, asset or expense at the same time, but on credit side, if it is equity settled, I will recognize the equity component in this transaction. And if it is cash, remember, if it is cash, I'm giving out cash. Therefore, I will credit the liability until it is settled when I credit cash. Until this liability is settled is when I will credit cash. But if I have not paid real cash, remember it's a cash and we have vesting condition. I said here we have vesting conditions. Therefore, if we have vesting conditions, it means I'm not recognizing this cash at that moment. It will be after the vesting period. Now I will be recognizing the liability for that vesting period is when I will have to recognize the cash at the end of the vesting period. Therefore, let's look at that question and see how we do it, Let's look at that question of November 2016 and see. November 2016, let's look at November 2016. There's like a simple question that we can begin with. November 2016, there is like a small question that we want to begin with. November 2016, I believe you have the handout. November 2016. November 2016. November 2016. As part of staff motivation, that is question number 4. Question number 4C. Question number 4C. As part of staff motivation program. Question number 4C. Question number 4C. November 2016. Question number 4C. Let's begin there. Let's begin there. As we move deeper into this. November 2016, question number 4C. As part of its staff motivation program, Beta Limited decided to grant each of its 600 employees 100 options to purchase the company shares effective from 1st April 2016. These options were conditional upon one still being in employment as at that 1st March 2016. The following additional details were provided with respect to the scheme. We have years ended 2017, 2018, 2019, 2020. Number of employees expected to terminate or leave employment. Then the fair value of each option. The fair value of the option was shillings 25 as at 1st April 2016. The exercise price of the option will be shillings 12, and the bar value of the company shares is shillings 6. The average market price of the shares over the 4 years to that 1st March 2020 is expected to be shillings 25. Required. Show how Beta Limited will report the transaction of the above scheme as per the requirements of IFRS to share-based payment over the 4 years ending that 1st March 2020. Assume all the eligible employees will exercise their rights on that 1st March 2020. 8 marks. Therefore, as part of the staff motivation program, Beta Limited decided to grant each of its 600 employees 100 options. Remember, option means, share options means the rights to purchase company shares in future at a fixed price, Like, for example, we can fix our price for the option like shillings 10 in 10 years to come. Therefore, that becomes the option, the right to purchase. You will have that option. Even if our shares moves to 200 per share market price, but you have the right to purchase them at shillings 10, the price that we fixed today at the future for the future. Therefore, that is the option, the right to purchase shares in future. Therefore, as part of staff motivation program, Beta Limited decided to grant each of its 600 employees 100 options to purchase the company's shares effective from 1st April 2016. These options were conditional upon one still being in employment as at that 1st March 2020. Therefore, we have the vesting period of 4 years. That vesting period is a vesting condition. You must be in employment for that period. If you leave during the year, then you forfeit that right. You will not get that right. Therefore, you need to know the vesting condition. That is service condition. You must be in service for you to vest or to qualify to a share-based transaction. The following additional details were provided with respect to the scheme. We have year ended, number of employees who left, therefore they will not qualify, then the fair value. Therefore, what we said is that you need to differentiate between the cash awards and equity settled. When examiner tells you that we have the option to purchase the company shares, that is equity settled. But if we have the right to cash awards or bonus in cash, that is cash settled share based. If you hear the examiner tells you that you have the right to cash awards, then that is cash settled. Or you have the right to bonus in cash, that is a cash settled. And now what will be the difference between equity and cash? Under equity settled, good friends, when we are computing the expense of the liability, we only adopt the fair value, one fair value, and this is the fair value at grant date, the fair value at which we entered into agreement. One fair value, even if it is 10 years, you only adopt one fair value that you'll be using to compute the expense or the liability. But if it is cash awards, good students, you need to remeasure the fair value at each reporting date. You need to remeasure. Every year, you remeasure the fair value. Therefore, if the examiner gives you the fair value, like in this question, it is equity settled. It is equity settled. Because why is it equity settled? Because we are going to purchase a company shares effective, from 1st of April 2016. That is equity settled. But if it is cash awards, then it is cash settled. Now, although we have different fair values in this question, but the only thing you need to be careful under equity settled, you only adopt the fair value at grant date when you entered into contract. Like in this question, the fair value of the option was shillings 25 as at 1st April 2016. Remember, we are closing our year on that 1st March 2017, which means that we started our year on 1st of April 2016. Therefore, that is the grant date. Therefore, every year, our fair value we shall use is 25, which was the fair value on granted. The exercise price of the option will be shillings 12, and the bar value of the company shares is shillings 6. The average market price of the share over the 4 years to that 1st March 2020 is expected to be 25. Now, on exercise, if these employees will decide to exercise their right at the end of the year of the 4 years, then they will use shillings 12, the exercise price. But although the bar value is shillings 6, but now if you are exercising the rights, you use the exercise price, then you recognize the share premium element. You recognize share premium element. Therefore, in this question, how do we determine the expense or liability according to IFRS 2? We shall say year. You say year. Computation of expense and liability, or liability, computation of expense. Then we report the expense, good students. Then we report the liability. We report the liability. We report the liability. Now, in year 2017, we have 600 employees. 600 employees. And in that 2017, at the end of 2017, 25 employees left. 25 employees left. Therefore, they will not vest for the transaction. Then you multiply by the option, which is 100. Then you multiply by the fair value at granted, which is 25. Although we are having 20 in the year 2017, but now if it is equity settled, you only adopt the fair value at granted. Then we said, if any share-based question has the vesting condition, then the expense or liability should be spread over the vesting period. Therefore, like this one, the vesting condition is 4 years. You need to finish 4 years. Therefore, in the first year, we need to take only the portion of the first year, whereby now we multiply by 1/4. We only take the portion of the first year because we want to spread the liability over the 4-year period, Therefore, you can give me the liability quickly on the expense. The liability and the expense, that is 600 minus 25. We get 575 times 100 times 25. We get, then we divide by 4 times 1. I'm getting 359, 375. 359, 375, 359, 359, 375, 359, 375. That is our expense in year 1 and the liability in year 1. This is the cumulative liability, and now this is the expense. Then we come to year 2, 2018. In year 2018, good students, in year 2018, we have now 25 employees already left. Therefore, we have 575 employees here. 575 minus, in year 2018, 15 leave. Then we multiply by 100 times 25, the fair value on granted, times now the cumulative liability of 2 years, 2/4. The cumulative liability for 2 years, that is 2/4. That is 575 minus 15. We get 560 times 100, then times 25. What we get, we multiply by 2/4. Divide by 2. We are getting 700. 700 is the cumulative liability for the second year. Cumulative liability for the second year. Then we get the expense. Remember, in the first year, our cumulative liability was 359, 375. In the next year, we have 700. It means the liability is increasing. When the liability increases, good students, then the difference is the expense. Now minus 359, 375. We have 340, 625. That is our expense from that transaction. That is the expense from that transaction. Then we move on to year 2019. 2019, now we have 560. Then 10 employees leave during year 2019. 10 employees leave. Times now the 100 times 25. Then times 3/4. Times 3/4. Because we are in year 3. 3/4. Therefore, we have 450 times 100 times 25 times 3 divided by 4. 843. I'm getting something like 843. I don't know if I'm correct. You can correct me. 750. If I'm not correct, you can correct me. You can correct me. I know you have good figures. That is 450. Sorry, not 450. It is 550. 550 times 100 times 25 divided by 4. It is 10, not this one. 103, 1250. 1250 minus 700. Minus 700. It is 331. 331, 250. 331, 250. Then in year 2020, we have 550 employees minus 10 times 100 options times 25 times 4/4. Now we are in the last year for the cumulative liability. Therefore, you take 540 times 100 times 25. I'm getting 1350. Then minus 1031, 250. It is 31, 18, 750. 31, 18, 750. Therefore, now this is the expense for the 4-year period. The expense for the 4-year period. And this is the liability that was incurred for the 4-year period. The liability that was incurred for the 4-year period. That is what you are required to do to get your marks in that question. But remember, the examiner also said that assume that all eligible employees will exercise their rights on that 1st March 2020. Now, the eligible employees are those who are remaining in the company, those who are in the company. The eligible employees are those who are remaining in the company, which are now eligible employees. Are those who are in the company, those who are in the company. And this will be now 540, those who are in the company, times 100 options, times now the fair value, the exercise price. Now on exercise, you use the exercise price, and our exercise price is shillings 12, but the bar value is 6. Therefore, when we come to the journal entry, you will credit, you debit bank with what we are receiving here. Like here now, how much are we receiving, good people? 540 times 100 times 12. That is 540 times 100 times 12. We are getting 648. Now it means that on exercise, the company will be getting that much from these people when they exercise the right now to purchase company shares. Therefore, here we say debit bank, because the company is receiving this cash, debit bank with shillings 648,000. Then you credit ordinary shares or equity instrument, ordinary shares, with the bar value, and the bar value examiner is saying that it is 6. Therefore, it will be 540 times 100 times 6, which will give us 324 shillings, 324,000. Then you also credit now share premium, because anything above the bar value, remember exercise price is 12, but the bar value is 6. Therefore, anything above the bar value is a share premium. Therefore, we also credit share premium, which equals to also shillings 324. Share premium equals to shillings 324. Therefore, that is how you are to get 8 marks in this question. How to get 8 marks in this question. Sometimes, good people, The examiner can give you this question component in a published question, in a published. Remember, in published, you are required to prepare the income statement and to prepare the balance sheet. Now, if you are to prepare the income statement, remember we have employee expense here, employee expense, share-based option expense here that you need to report. Then at the end of the year, for example, if it is year 2017, we have the liability to report in the balance sheet, the liability. But now, because it is equity settled, you don't report it as a liability. You report it under equity component, under equity. Because I said that if it is equity settled, you need to debit for this expense, you debit expense account, staff cost, like staff cost, like staff cost. You debit like staff cost, 359, 375. Then you credit employee share option, employee option, or just equity component, or just equity, with 359, 375. Therefore, in this, remember, if you are preparing the balance sheet, you have to report this expense in the balance sheet, like in 2013, I believe, December 2013. In December 2013, we have a component of share-based. If you do that question, we have a component of share-based. And now for this component of share-based, you are required to compute the expense. This expense you report in the income statement. Then you have this liability, but now this one you report it as under equity. But if it is cash award, then this one will be reported as liability under balance sheet. You report it as a liability under balance sheet. I believe you are moving on well. If you have a question, kindly you ask. If you have a question, kindly you ask. If you have a question, kindly you ask as we move on. Before we move on to another question. Okay, if you don't have a question, I have a question here that I want us to do. I have a question here that you will write. It's not that long. Like a small question, I got it from my book. I got it from my book. We can attempt it. Illustration question. You can write. On 1st January 2011, an entity grants 100 share options to each of its.
Last journal entries.
Tom, you are asking the journal entries. I don't know if it is for exercise, on exercise. If it is on exercise, we said you debit bank with total amount of exercise, which was 648. Then you credit ordinary shares with the par value. Remember, the examiner said that the par value is shilling 6. Therefore, and the exercise price is shilling 12. Therefore, ordinary share will take par value 324. Then the share premium is also shilling 6. Then it goes to share premium. That is now on exercise. On exercise, when eligible employees exercise. On exercise, that is how you treat that one, on exercise. But now for the expense and liability, there are these ones. Expense and liability, there are these ones. Okay, let's write this and see how we do it as we move on. On 1st January 2011, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employee working for the entity. On 1st January 2011, an entity grants, on 1st January 2011, an entity grants 100 share options, 100 share options, 100 share options to each of its 400 employees, to each of its 400 employees, each of its 400 employees. Full stop. Each grant is conditional. Each grant is conditional upon the employee working for the entity. Each grant is conditional upon the employee working for an entity. Each grant is conditional upon the employee working for an entity. Each grant is conditional upon the employee working for the entity until that 1st December 2013. Until that 1st December 2013. The fair value of each share option is shillings 20. The fair value of each share option is shillings 20. The fair value of each share option is shillings 20. During 2011, 20 employees leave. During 2011, 20 employees leave, and the entity estimates that 20%. During 2011, 20 employees leave, and the entity estimates that 20 employees of 20% of the employees will leave during the 3-year period. During 2011, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. During 2012, 25 employees leave. 25 employees leave. And the entity now estimates during 2012, 25 employees leave, and the entity now estimates that 25% of its employees, the entity estimates that 25% of its employees will leave during the 3-year period. During the 3-year period. During 2013, 10 employees leave. During 2013, 10 employees leave. Required. Show how the entity will account for the expense. Show how the entity will account for the expense. Required. Show how the entity will account for the expense. Required. Show how the entity will account for the expense. Show how the entity will account for the expense. Show how the entity will account for the expense. I will repeat the question. On 1st January 2011, an entity grants 100 share options to each of its 400 employees. Each grant is conditional upon the employee working for the entity until that 1st December 2013. The fair value of each share option is shillings 20. During year 2011, 20 employees leave, and the entity estimates that 20% of the employees will leave during the 3-year period. During 2012, a further 25 employees leave, and entity now estimates that 25% of the employees will leave during the 3-year period. During 2013, a further 10 employees leave required. Show how the entity will account for the expense. Now remember, we need just to compute the expense and the liability. Therefore, you say illustration question. We have here computation of expense. Then we have the expense. We report the expense during the year. Then the liability. Then the liability. The liability. We have the liability. Therefore, in year 2011, we have a total of 400 employees. 400 employees. 400 employees. Then here, remember what is funny in this question, the examiner is using the estimates. Now, whenever you have the estimates and the actual only comes in the last year. Actual will come in the last year. But if we have the estimate, then like in the first year, we estimated that 20 employees left. That is the actual employees that left. But now the entity also estimates that 20% of the employees will leave in year 1, 2, and 3. Therefore, which means that we are going to use the estimate of the employees who are going in year 1. Then in year 2, we use also the estimate. And in year 2, remember we are going to use the estimate because they say the company also estimates that 25% of the employees will leave during the 3-year period. Therefore, which means you are also going to use the estimate. But now during the year 2013, which is our last year, 10 employees leave. There is no estimate in 2013. Therefore, it means that the actual of year 1, the actual of year 2 will not appear in year 2. It will only appear in year 3. Like now, for example, here, we have 400 employees in year 1, but we estimate that 20% will leave. Therefore, if 20% will leave, it means we are remaining with 80% of the employees who will vest. 20 employees who will vest. Now, if 20 employees who will vest, then we multiply by the option, which is 100. Then we multiply by our fair value, which is 20. Then time apportionment of 1/3 for us to get the expense for the year. The expense for the year. Therefore, here you just turn on your calculator and now take 400 times 80%. We get 320 times 100 options times 20. Then we multiply by a third. We multiply by a third, whereby we get 213,333. 213,333. That is our expense and liability for the first year. Now, when we come to year 2, 2012, we have 400 employees. Then we estimate that for the 3-year period, 25% will leave. Therefore, the only employees that will remain is 75%. Times 100 times 20 times 2/3. Remember,
where did you get a third?
Remember, I'm using a third because now the vesting period is 3 years. The vesting period is 3 years. And I said if the vesting period is 3 years, then you need to spread all this over the period. Therefore, remember in the first question, it was 4 years. Therefore, you are using a quarter. 1/4. in the first year. But now, because the vesting period is from 2011 to 2013, which is 3 years, then we need to multiply by that. In year 2, we multiply by 2/3. In year 3, 3/3. That is where we are getting that. Therefore, here it is 400 times 0.75 times 100 in year 2. We multiply by 20, then we multiply by 2/3. I'm getting something like 400. I don't know if I'm correct. Something like 400. 400. If I'm wrong, you correct me. Minus, remember our cumulative liability here was 213, here is 400, it is increasing. Therefore, you subtract 213, 333. I'm getting 186,667. My expense now is 186,667. Then in year 2013, which is our last year, now we have 400 employees. 20 left in year 1. 20 employees left in year 1. Then 25 employees left in year 2. Then 10 employees live in year 3. Therefore, here I subtract 20 in year 1. I subtract 25 in year 2. Then I subtract 10 in year 3. Then I multiply by 100. Then I multiply by 20. Then I multiply by 3/3 to get the cumulative liability for year 3. Therefore, it is 400 minus 20 minus 25 minus 10. I get 345 times 100 times 20. I'm getting 690 minus 400. I'm getting something like 290. 290. That is how you will report that transaction to get 7 marks in this question. To get 7 marks in this question. For you to get 7 marks in this question, that is how you are supposed to do it to get 7 marks in this question. To get 7 marks in this question. Okay, that is how you do questions under equity settled. The essence of this is to know how to adopt the fair value. Remember, even if you are given how many fair values, if it is equity settled, you only adopt one fair value, and the fair value you adopt is the fair value at grant date. The fair value at grant date. That is the fair value you adopt for the rest of the period. But now we want to check on cash awards. Under cash awards, good friends, we say now we measure the fair value at each reporting date. We measure the fair value at each reporting date. We measure the fair value at each reporting date. Now, how do we measure the fair value? Like, for example, in the year 20, for example, year 2011, you are given the fair value as 610. Then it means that is the fair value that is prevailing that we use for the cash award. Now, when we come to year 2011, now 2012, they give you the fair value like shillings now 15 or 20. That is the fair value that is prevailing. That is the fair value that you need to use for the rest of the period. That is what we mean by the cash awards. Then I want us to do one question, and after we do this question, then we do another question. I posted a question for you for revision. I believe now you will do for me that question. After we have done 2 questions in cash awards, then it means you will do for me that question that I posted for you yesterday. I believe you will do for me that question. Okay, now for cash awards, let's move to cash awards. Let's move to cash awards and see how you get the expense or liability in cash awards. Expense or liability in cash awards. Cash awards, or we can just say cash settled. Cash settled transaction. Then you can say that the standard requires that under cash awards, the fair value should be remeasured at each reporting date. The fair value should be remeasured at each reporting date. The fair value should be remeasured at each reporting date. That will be the major difference between equity settled and cash settled. Equity settled and cash settled. Now, we can look at a question in, I think, a question in May 2017. A question in, I think, December 2017. December 2017. December 2017. December 2017. December 2017. Open December 2017. Question number 2B. Question number 2B. December 2017. Question number 2B. December 2017. Question number 2B. After this, we do December 2019. After this question, we do December 2019. Then we do November 2019. Then I believe everything shall be okay. Everything shall be okay. And then you do the assignment. You do the assignment for the question I gave you yesterday using the example of November 2019. Now let's look at this question number B. Question B in this question number 2B. If you are there, December 2017, question number 2B. On 1st January 2014, Ali Limited promised to pay its 200 employees a bonus in cash that would be based on how the company's shares performed on the securities exchange. The bonus was to be paid on that 1st December 2016 as long as the market price of the company's shares was shillings 55 and above, and the employee was still working for the company. As at 1st January 2014, the market price of the share was shillings 50 and the bar value of one share was shillings 10. The bonus was to be equivalent of 100 shares. The bonus was equivalent of 100 shares. The following information in relation to the 3 years was a failure. Year ended, number of employees leaving, market price per share. That 1st December 2014, 10 employees leave, the market price is 55. 2015, 15 employees leave, the market price is 55. December 2016, 15 employees leave, the market price is 60. All employees who are in employment as of that 1st December 2013 were paid the bonus. Show how the bonus will be accounted for and reported over the 3-year period ended that 1st December 2016. 6 marks. Now, good students, these are 6 marks for free. 6 marks for free. Okay, let's see how you compute the expense and you compute the liability in this question. When you hear that it is cash awards or bonus in cash, then it means it is cash settled. Which means if it is cash settled, now we measure the fair value. We use the fair value that is prevailing at each reporting date, at each reporting period. Now, on 1st January 2014, RE Limited promised to pay its 200 employees bonus in cash that will be based on how the company's shares performed on the securities exchange. The bonus was to be paid on that 1st December 2016 as long as the market price of the company shares was shillings 55 and above. Remember, the examiner is putting some condition here that the market price is shillings 55, and the employee must be in service. The employee must be in service for that period. The employee must be in service for that period. As at 1st January 2014, the market price of the company, the share was shillings 50. That is in January 2014. And the bar value of the shares was shillings 10. The bonus was to be the equivalent of 100 options. The following information in relation to the 3 years was availed. Therefore, here we shall say here, computation of expense. Then we report the expense. Then we have the liability. We have the liability. We have the liability. At the end of year, December 2014, we have a total of 200 employees. Then, during that year, 10 employees leave. 10 employees leave. Then we multiply by our share option, which is equivalent to 100. The share option is equivalent to 100 shares. Bonus was to be equivalent to 100 shares. Then times our fair value during that year, which is 55. Which is 55. Then times, remember it is 3 years. Therefore, our vesting period is 3 years. Therefore, you take 1/3. Our vesting period is 3 years. You take 1/3. You take 1/3. Therefore, here, good friends, we shall have 190 times 100 times 55 times 1/3. I'm getting 348,333. 348,333. 348,333. 348,333. Then in December 2015, remember 10 employees left in year 1. 10 employees. Therefore, it will be 200 minus 10 minus, now those who left in year 2015, which is 15 employees left, times 100 options, times our fair value, which is 58, times 2/3 year apportionment. Then you get our expense and liability. That is 200 minus 25 times 100 times 58 times 2/3. I'm getting 6. Our cumulative liability is 676. 666. Then I get the difference. The difference with 348, 333. I'm getting 328, 333. 328, 333. Then I come to year 4. That is December 2016, my last year. Remember already 200 employees, 10 left in year 1, 15 left in year 2, then 15 left in year 3. Then I multiply by 100. I multiply by my fair value, which is 60. I multiply by my fair value, which is 60 times 3/3. Remember, in this, we are changing the fair value, but in equity, you don't change the fair value. Under equity, you don't change the fair value. You don't remeasure the fair value. Therefore, this one will be 200 minus 40, which will be 160. 160 times 100 times 60. I'm getting 960. I'm getting 960. Then I subtract 67, 6. I'm getting 283. 3334. This is the expense. This is the liability. If it is not a published question, remember you need to report the expense. Remember, this is just an extract of how you get the expense for liability. The essence of this, good students, is to report in your income statement or in the balance sheet. For example, if you are preparing your final accounts, income statement that we have been preparing in groups, in published income statement, I need to recognize the expense. You check which year are you preparing the financial statements. 2015. Okay, if it is 2015, then you need to report this. You need to report this in your income statement. Then you report this as a liability. Remember, this is a cash award. Therefore, this one you report as a liability. But at the end now, this is what you will pay as cash. Remember, this is what you are going to pay as cash. Therefore, at the end, you will now credit your cash with this 960. You credit cash because that is what you are going to pay at the end of the period. These people have vested. You need to pay this cash. Therefore, you are paying this at the end. You credit cash. But here, remember, it's just cumulative liabilities. It is cumulative liabilities. That is how you get marks in share-based payment, and it's a very common question. As you can see, each year there is share-based. Each semester, not even each year.
So that's a question. Assuming the share price fell below 55 in year 2, could we have calculated the expense?
Now, if it falls, Sarah, you are asking, suppose this one was below 55. Remember, we are measuring the fair value. Therefore, the fair value that is prevailing is what you use. The fair value that is prevailing, even if, for example, it is 52, 54. It means now that is the fair value that is prevailing at the reporting date, and that is the fair value you use. You don't put it high, but that is now what you use. Okay, let's look at the last sitting question. Our last question, the last sitting question. Then after this, now you do for me the assignment I posted on your platform. I posted a question. That question is a good question. But now, before you do that question, let's do the question of November 2019, share-based. November 2019. It is also a cash award. It's a cash award. It is a cash award. November 2019, it is a cash award. Let's do it and see those who did the exam last sitting, what they were supposed to do. Those who did the exam last sitting, what were they supposed to do?
Andrew was asking, what is the key difference between equity settled and cash settled?
Now, Andrew, you are asking the major difference between equity settled and cash settled. Now, if you are asked such like a question, you can explain to examiner that under equity settled, we adopt the fair value at the grant date. That is the difference number one. We adopt the fair value at the grant date, but under cash awards, you remeasure the fair value at each reporting date. You remeasure the fair value at each reporting date. Then number two, Andrew, number two difference is that under equity settled, we have the difference in accounting. Remember, I showed you the difference in accounting on measurement or recognition. Under equity, we shall have to debit. You debit expense or asset. You debit the expense or asset when you are accounting for this or expense. Then you credit. Then you credit the equity instrument. You credit equity instrument. Equity instrument for that liability or that accrued expense. For that accrued expense, you credit equity component, equity instrument. But if it is cash, you have to debit asset or expense. Then you credit liability, accrued liability. You credit the liability at that point. Or if it's now at the end, of the period, you need now to debit, you credit here cash. If it is at the end you are paying, you credit cash. But here, if you are paying now, credit share capital. Share capital. Here you credit share capital, in short. Here you credit cash for that settlement of the liability. Therefore, the difference will come in recognition and now in accounting. Therefore, first the difference comes in the adoption of the fair value, then the second on how we account for this transaction. On how we account for the transaction in the books. Okay, let's look at the question of November 2019. I believe you are there. November 2019. If you are there, November 2019. I believe it is question number 3C. Question number 3C. Question number 3C. Question number 3C. Then after this, you will do for me the question I posted because it is more or less the same. I will only tell you the difference. Between the two questions, but they are more or less the same. I will just explain the difference, then you do for me. And make sure you do the assignments. Because now the assignments will keep you now remembering this concept until the exam comes in September. Remember our exam, if all will remain constant, it will be in September, if all will remain constant. But you also continue praying that this COVID thing goes away, vanishes away. I believe you are there, good students. The question number 3C. On 1st January 2014, Wale Limited granted its 500, I believe, its 500 employees share options to buy 1,000 shares each from the company on condition that they continue working for the company until that 1st December 2016. Until that 1st December 2016. During the year 2014, that 5 employees left, and it was estimated that further 60 employees will leave in years 2015 and 2016. During the year 2015, 40 employees left, and it was estimated that further 25 employees will leave during year 2016. During the year 2016, 22 employees left. As at that 1st December 2016, 150 employees exercised their options. Another 140 employees exercised their options on that 1st December 2017, and the remaining 113 exercised their options as at that 1st December 2018. The terms of the options were that the company would pay for the shares on behalf of the employees. The fair value of the shares were as follows. That 1st December fair value, we have 72, 77, 91, 107, and 125. Now, required, the amounts to be recognized in the income statement as an expense for each of the years, and the liability to be recognized in the statement of financial position as at that 1st December 20 each year. That 1st December each year. Now, in this question, remember there was an exercise part of these employees. Now, we need now to also factor in the exercise part in this question. The exercise part in this question. We need to factor in the exercise part in this question. Therefore, let's see. You say November 2019 question number 1C. We say here, then computation of expense. Then we report the expense. Then we report the liability. We report the liability. I believe you are there. I believe you are there. Then we read the question. On 1st January 2014, Wale Limited granted 500 employees options to buy 100 shares each from the company on condition that they continue working for the company until that 1st December 2016. During the year ended that 1st 2014, that 5 employees left, and it was estimated that further 60 employees would leave during years 2015 and 2016. During the year 2015, 40 employees left, and it was estimated that further 25 employees would leave in the year 2016. During the year 2016, 22 employees left. As at that 1st December 2016, 150 employees exercised their option, another employees exercise their option on that 1st December 2017, and the remaining 113 exercise their option as at that 1st December 2018. The terms of the options were that the company would pay for the shares on behalf of the employees. The company will pay the shares for the employees. The fair values of the shares were as follows. Then we have the fair values. Now, I want you good students to tell me, from what we have discussed, is this a cash award or is it equity settled? Tell me, good students, if it is a cash award or equity settled. Remember, examiner also is sometimes very tricky if you are not keen in reading the question.
Virginia saying cash.
Yes, Virginia, you are saying cash.
Equity. Most of them are saying cash.
It is a cash settled, and what is making it cash settled? Remember, the terms of the option were that the company would pay for the shares on behalf of the employees. Therefore, it was equity settled, but now because now the company will pay on behalf of the employees. Remember, they started by saying they purchase shares of the company. It becomes equity settled. But now, when we come down there, the terms and conditions, they say that now the company will pay, the company will have to pay cash on behalf of the employees, a cash on behalf of the employees. Therefore, it becomes a cash award. Otherwise, we would have been given the fair value at grant date. We would have been given the fair value at grant date. Therefore, let's compute in year 2014, good students, we have 500 employees. And out of 500 employees, 35 employees left in year one. That 5 employees left in year one. And the company estimates that 60 employees will leave during years 2 and 3. Remember, when you are doing accounting, we always use estimates of the following years, because this is something we are using to compute. This is something we are using now to compute the expense and liability for the vesting period. Therefore, here, good students, it means that we include also the estimate of 60 of years 2 and 3. We include the estimate of 60 in years 2 and 3. Then we multiply by the options, which is 1,000. Then we multiply by the fair value, which is 72. Then we multiply by our vesting period is 3 years. Remember, we consider vesting period. Although the examiner says that it will go and up to 5 years, but what is the vesting period? The vesting period is 3 years. That is what, from 2014 to 2016, 3 years period. That is what you use as your year. You don't use 5 years, but vesting, you consider vesting period. Okay, it will be 500 minus 90, that is 405, times 1,000, times 72. Then you divide by, you multiply by 1/3. I'm getting 9720. I'm getting 9720.
Or is asking, do you include the 60 for 2015 only?
What?
Elijah is asking, do you only include 60 for 2015 only?
Now the examiner is saying that Elijah, that further 60 will be leave in year 2015 and 2016. Therefore, that is the estimate of the 2 years. The estimate of the 2 years, 2015 and 2016. Therefore, you include both because it's 2015. Remember, we are in year 1, but we are estimating that in year 2 and 3, 2015 and 2016, 60 will leave. Therefore, you include those estimates. Then we come to year 2, 2015. 2015 now we have 4 or 5 sorry, not 4 or 5. We have 465. Because this was just estimate, it was not actual. It was just used to compute the expense and the liability due to expenses. When you do errors and estimates, you will see how estimates behave. But now, this is now estimate. You don't now include in year 1. It was in year 2. It was the estimate for year 1. Then in year 2, good students, in year 2, 4 or 5, then the examiner is saying that during year 2015, 40 employees leave, and the company estimates that further 25 employees will leave in year 2016. Therefore, we estimate that 25 will leave in year 2016. Then you multiply by 1,000. Then you multiply by the fair value, which is 77.5. You multiply by 2 over 3. 2 over 3.
There is another. Ruth is saying, what if they will have estimated that 60 will live during the year 2014, 2015, 2016? Shall we subtract the 35 who left during year 1?
Now, if Esther, you are asking, suppose they say that 60 will live during year 2014, 2016, 2015, 2016. Then it means that 60 will affect this. We shall only use 60. We shall only use 60 because it's the estimate of the 3 years. It's the estimate of the 3 years. Then when we come here, also they should also give us now the estimate, or they give us the actual. Therefore, in year 2015, 465 minus 40 minus 25, we get 400, if I'm not wrong. Then we multiply by 60,000. Then we multiply by 77.5. Then we multiply by 2 over 3. I'm getting something like 2666. I don't know if I'm wrong. 2666. You can correct me if I'm wrong. 6666. That is what I'm getting. Then I subtract 97, 20. I'm getting something like 109, 46, 666. This is what I'm getting as my expense. Then I come to year 2015, 2016, 2015, 2016. Remember, I forgot to tell you to put another column here. If you have space, you can put another column for shillings here for the exercise. If you have the extra column, you can include another column. If you have space, you can include the column. You can include the column if you have space for the exercise. For the exercise, you can include the column here. You can include the column. for the exercise, because in 2016 there was exercise. There was exercise in 2016. There was exercise in 2016. Therefore, the examiner says that although 22 employees left, but now before we do the left, we assert that 1st December 2016, 150 employees exercised their options and another 140 employees exercised their options on that 1st December 2017. Therefore, in 2016 here, we have two things. We have those who exercised and those who did not exercise. Therefore, those who exercise are 150. They exercise their rights. Times now the options, times now the price in 2016. The price in 2016, they exercised in 2016, that is 91. They exercised in 2016, therefore it will be 150, those who exercised, times 1,000, times 91. Times 91, I'm getting, you put in the second column here, I requested that you put another column there. I'm getting 1365, 1365, 000, like that. Then in the same 2016, good friends, same 2016, those who have not exercised, not yet exercised, not yet exercised, those who have not yet exercised. Remember here, we had remained with 400 minus 22 who left in 2016 minus 150 who already exercised their rights, Here, in year 2015, we remained with 400. Now, when we come to 2016, 150 exercised. We have their expense for the exercise. Then, those who did not exercise, we have 400 minus 22 who left, then minus 150 who exercised. Then we multiply by our options. Then we multiply by our fair value, which is 91. Then 3/3. 3/3. I don't know if you are getting me there. Therefore, it is 400 minus 22 minus 150 who had already exercised. We get 228. I believe you are getting 228, or how many left? We are getting 228. Sorry, this one estimate we don't include. Therefore, it is 460 minus 40. It is 460 minus 40. 465 minus 40, who left? It is 425, not 400. 425. 425. This is the estimate. Therefore, 425 minus 22 minus 150, we get 253 times 1,000 times 91. I'm getting 23. It comes to our liability column. That is 23,023. I'm getting that way. 23. Then, for me now to get the expense, I need to get the expense that comes out of this, then I add to this so that it becomes my cumulative expense. Therefore, I will take 23 minus 20 because the liability is still increasing, minus 20, minus 26, 666. I'm getting 23, 56, 334. Then I add these expenses for those who exercise and those who have not exercised. I get one expense here. Therefore, I add plus 13, 650, 13,650 thousands. 13,650 thousands. I'm getting 16,00,6334. That is what I'm getting as the total expense for year 2016. Remember, you get the cumulative liability, you compare this, then this one you add them together to get the cumulative expense there. Then we go to 2017. 2017. In 2017, they tell us that 140 employees exercised their rights. 140 employees. Therefore, those who exercised will be 140 times 1,000 times the fair value at that time is 107. 107, so that we get the expense on exercise in the second column. Therefore, let's see 140 times 1,000 times 107. I'm getting 1498. Those who exercised 1498, 000 for those who exercised. Then in same 2017, not yet exercised. Those who have not exercised, not yet exercised. Not yet exercised. Remember, we had 425. We had 425 here.
Yes. What happened to the further 25 estimated to leave in 2016?
Remember, that was estimated to leave in 2016, but we were in 2015, Cynthia. Cynthia, remember, the examiner said that we are in 2015, but we estimate that 25 will leave in 2013, in 2016. Therefore, we included them in 2015. You don't include the estimate in 2016. We include the estimate in the year we are estimating, because you are in 2015, and we estimated that in 2016, 25 will leave. We included them in 2015. Now, when we come to 2016, we have the actual of 22. Actual of 22 who left. That is why we are including them in 2016 actual. But in 2015, we already included the estimate of 2016. And here we included the estimate of 2015 and 2016 Cynthia. Therefore, when we come here, those who have not exercised, it is 253 minus 140. Those who have not exercised, 215 minus 140, we get 113. I'm getting 113. Then times 1,000 options times the fair value in 2017, which is 107. Times the fair value at that point, which is 107. Therefore, it will be 113. 113 times 1,000 times 1,000 times 107. I'm getting 12. I'm getting 12. 09 1 12 09 111 100. Then I compare with this. Remember, this one is 23. This one is 12. My liability is reducing. If the liability reduces with students, then it means I'm earning something. It becomes income. Therefore, the difference between this and this will be income. Therefore, my 23 minus 12. I'm getting 10. I'm getting 1093. I'm getting 1093, but now it is income to me. It is income because now the liability is reducing. Remember, here I had 23, here I have 12. Therefore, the expense, the liability is reducing, it becomes income. That is why I'm putting in bracket. Now to get the expense here, I compare this with this, which means I take this minus this. $14,980 minus this one, I'm getting 4,000. Expense of 480. That is my expense in 2017. Expense in 2017. This is the liability in 2017. Then I come to 2018. 2018, exercised in 2018, I have 113 who exercised in 2018 times 1,000 times the fair value is 125. The fair value is 125. Therefore, I get that is 113 times 1,000 times 125. I'm getting 14,125,000. Then in the same 2018, not yet exercised in 2018 for us to complete the transaction, it is 0 because all employees have exercised in 2013, in 2018 here. Therefore, not yet exercised is 0 times 1,000 times the fair value, which is 25, which means here I have 0. Liability here I have 0. The liability I have 0, which means my expense will be reduced with this one. Therefore, here I bring 12,091,000, but negative because this one and 0. This one and 0. Then my expense here, good students, I also subtract here. Therefore, I take my 14,125,000 minus 12,091 thousands. I'm getting 203 for like this, my expense. Therefore, that is how you are supposed to account for the last sitting question to get 8 marks. Although guys NEP gave fewer marks than SCCA, it was supposed to give 12 marks for this question, but they gave only 8 marks. They only gave 8 marks for this question. Therefore, now remember in this question, you are supposed to be given the intrinsic value. When they exercise here, like here, on exercise, you are supposed to use the intrinsic values. But this examiner did not give us the intrinsic values. That is why we are just using the fair values. But now in the question I gave you, good friends, on exercise, you are to use the intrinsic values. You are to use the intrinsic values. Intrinsic values, the definition of intrinsic values is the difference between the fair value and exercise price. But now you are not given, we just used the fair value. But in the question I gave you, there is intrinsic values. Now on exercise, good students, you will be using the intrinsic values on exercise. But now not yet exercise, just use the fair value. On exercise, use the intrinsic values. That is the difference between the question I gave you and this question. And remember, this question was adopted from SCCA, but now they ignored the intrinsic values. Therefore, this is what you need to do. Do the assignment I gave you, then all shall be well. Let's meet, God willing, next weekend as we do income taxes, because our time is already up, as we do income taxes. And I'm also preparing very good group questions that I want us to do maybe in the next weekend or the coming weekend. We want now to discuss and other questions of group in our blogs. Remember, we are in our blogs. Anything we are doing, we shall not repeat it again until you do the exams. Therefore, take them seriously, because now they will help you to pass your exams. If you revise very well, then the exams will be as easy as possible. Thank you very much and have a good time.